on how to play earnings. This is an earnings playbook using an example with Aapl. And this can be applied to any earnings report or any binary event for that matter. Now, the first thing you have to do in ascertaining the expected move for a certain stock is to price out a straddle. So you take the at the money call and at the money put, combine them, and you add that to the current price and subtract it from the current price, and that will give you the upper expected move and lower expected move. So Aapl reports earnings on Thursday after close, and the straddle is currently trading at around $7. So looking at the chart over here, you can see that the closing price on Friday was $115.09. And if we go up $7, we get to $122 approximately. If we go down $7, we get to $108. So those are our upper and lower expected moves for the week. Now again, this can be applied to any different ticker. It doesn't matter what the ticker is. You need to use the same methodology, right? Price out the straddle for the expected upper and lower moves, right? And then if you price out a strangle, which in this case would be at the 122 strike on the call side and at the 108 strike on the put side, you get about $2 over here as well in premium. So if you add that to the upper expected move of 122, that gives you 124, which is the upper potential move, and subtract that from the lower expected move of 108, which gives you a lower potential move of 106, right? So now those strategies are strategies you could use if you believe that Aapl is going to have a greater than expected or potential move, right? In the case of buying a straddle, you're paying $7 approximately, and you need a greater than $7 move up or down in order to profit off the strategy. In this case, the risk reward, in my opinion, is not there. But in certain events where you have a massive move expected and the market's underpricing that move, you can win on that strategy using a straddle, right? A strangle requires less premium, obviously $2, but you require a much larger move to either the upside or downside. And you don't care what direction it moves in as long as it moves big in one direction, right? But again, the probability of profit on the trade is not very high, right? So that's if you're neutral on a certain ticker. So if you're neutral on Aapl, for example, and you think it's going to move greater than the market expects it to move, you can use a straddle or a strangle, although the asymmetry of risk is not really there, right? Now, if you're bullish, you can use a bull call spread, which is priced out over here. It would cost you approximately $2.35, and that would be created by going long the 115 call and short the 122 call. So you're long at the money and you're short right at the area of the upper expected move, right? In this case, your maximum gain would be 7 less 235, which is $4.65. So that would be achieved if Aapl were to expire above 122 come Friday, right? That's if you're bullish. Because if you're bullish and you just buy the call option, which costs about $350, your break even is $118.50, and you need to be directionally correct, and you need a decent move to the upside to break even as well on the trade, right? Obviously, with the call spread, you're capping your gains, which is the downside of it, but it's a method of reducing your risk, right? I won't get into butterflies at all because it makes it too complex, but you can also use butterflies if you know what you're doing, or broken wing butterflies to further reduce your risk, or even combos if you wanted to. But again, I won't get into those strategies because this is meant to be a earnings playbook, if you will, right? Again, if you're bearish, you can go with the bear put spread, where you buy the 115 put, you sell the 108 put against it, and your overall debit is about $2.60. So in this case, you're risking $2.60 to make $4.40, right? And your maximum profit is achieved if Aapl expires below the 108 strike, right? That's your bearish strategy. So we've covered some of your neutral strategies as well as your bullish strategy and bearish strategy. Now we're looking at the iron condor, which is a credit strategy. This is more for the theta gang guys over here, right? And again, you want to go outside the expected move. Even this one over here that I've built, the 108 put spread to 105 and the 122 to the 125 on the call side, iron condor. This might still be too tight, right? But again, this is for exemplary purposes. So you want to look at this as an example, and obviously, tinker with the different strike prices and figure out your risk reward, right? In this case, if you were to sell the 122 strike call and buy the 125 strike call and sell the 108 strike put and buy the 105 strike put, you're creating an iron condor. Your maximum profit is achieved if Aapl expires by Friday anywhere between 122 and 108, right? Now, obviously, because you're doing a credit strategy over here, I would always recommend to close out both sides of the trade no matter what, even for a penny at expiration in the event that Aapl expires near the money and after hours goes in the money, because keep in mind that options can be assigned up until 5:30 p.m. Eastern Standard Time by the Option Clearing Corporation, right? Very important to remember that, right? The last strategy we're going to go over is the iron butterfly, which over here says iron condor. It's actually the iron butterfly. In this case, you're selling the straddle and you're buying the strangle, right? So effectively, you're creating an iron condor at the money. You're selling the 115 strike call, buying the selling the 115 strike put as well. You're buying the 122 strike call, and you're buying the 108 strike put. Your credit received is about $5 over here, which means your break even is plus or minus 5 from the current price, so 120 or 110. That's your break even price. And your maximum loss would be 7 minus 5 on either side, so $2 maximum loss. And that would occur if Aapl were to expire below 108 or above 122, right? And again, this methodology can be applied to any earnings event, any binary event whatsoever. The key here is that you want to have high liquidity, because any option chain with low liquidity won't be conducive to a profit or a high probability of profit option strategy, right? Hope this helps, and if you have any comments, drop them below. Thank you very much, and have a good night.